Welcome to CatEye U.S. stock. We watch markets with calm focus and sharp instincts. It's Thursday, January 15th, 2026, and the market didn't really relax so much as clarify its views. Indexes finished higher, but the real story was who actually led. Earnings-proven AI chipmakers and a few solid cyclicals pulled the tape up, while big platform tech and healthcare traded more carefully. Policy talk out of Washington and stretched valuations kept defensives in the mix. Net, this was a day where proof over promise decided who got paid. Look at the S&P 500 heatmap, and the pattern jumps out. A sea of bright green in semiconductors, with names like NVDA and AMD visually dwarfing the board. Right next to them, the usual mega-cap platforms, Apple, Microsoft, Alphabet, are quietly red. Healthcare carves out its own red island, reminding traders that policy and valuation risk are still in play. Staples and utilities, just scattered pockets of green. It's a market that's up on the day, but carried by a very specific set of winners. Building right off that heat map, the money flow told the same story. Capital moved aggressively inside tech, away from big platform exposure and toward the AI infrastructure stack, the chipmakers and the suppliers tied directly to advanced nodes. Financials and a slice of cyclicals caught a bid, as investors leaned into balance sheet strength and clearer earnings visibility. On the flip side, healthcare names, especially high-expectation drug makers, stayed under pressure as policy noise and lofty multiples collided. Defensive growth wasn't abandoned, but it was more of a quiet hedge than a full-on hiding place. And that leaves us with a clear tension. Yes, the major indexes finished in the green, but the lift came from a shrinking group of AI and cyclical winners. The AI theme itself is moving into a maturity phase. Investors want to see that all this CapEx actually turns into cash flow and durable demand. At the same time, new healthcare policy ideas and reimbursement questions kept that sector on the back foot. Put together, it's a market that's cautiously constructive, but increasingly dependent on a few proven names. And that's exactly where we go next, as we drill into the key stocks. Around trading desks, the talk was more skeptical than the closing prices might suggest. Unconfirmed chatter centered on how long this AI hardware cycle can really run without a stumble, and whether rallies this dependent on chips can hold if Brett doesn't improve. On the policy side, President Trump's healthcare payment idea was treated strictly as concept, not certainty, with a lot of whispering about implementation risk and cost, not upside. And even with semis ripping, there wasn't much appetite, according to desks, to chase every speculative AI ticker in sight. The semiconductor sector staged a sharp rebound today, and the spark came from Taiwan Semiconductor. TSMC delivered a strong earnings report, but more importantly, its forward outlook sent a clear message to markets. AI-driven demand remains intact. The company posted record profits, and crucially, guided to a higher-than-expected capital spending plan for 2026, signaling confidence that demand for advanced chips will remain strong. That CapEx signal mattered. Investors have been debating whether AI hardware spending is peaking or simply pausing. TSMC's willingness to lean into another heavy investment cycle reframed that debate, suggesting the buildout is far from over. The reaction rippled quickly across the chip ecosystem. Equipment makers rallied as higher foundry spending translated into stronger future order books, while U.S. semiconductor names tied to AI infrastructure also moved higher. In market terms, this wasn't just a single stock reaction. It was a sentiment reset. Semiconductors shifted from a source of recent pressure back into leadership, helping stabilize the broader tape and nudging risk appetite higher. NVDA sat right at the center of today's move. The stock pushed higher as traders latched onto TSMC's message that advanced node and AI accelerator demand is still ramping. That's direct validation for NVIDIA's data center GPU story and for the broader AI CapEx cycle that's been powering the indexes. With leadership already narrow, every uptick in NVIDIA carries extra weight for the S&P and the Nasdaq. And today it reinforced the idea that for now, this AI build-out is still being treated as real earnings power, not just blue sky hope. AMD also grabbed attention, moving higher as investors leaned into its role as a challenger in AI accelerators. A fresh endorsement from the street, paired with TSMC's strong AI commentary, kept the share gain narrative front and center. In a market that's starting to price the maturity phase of the AI cycle, AMD benefited from sitting at the intersection of credible roadmaps and expanding opportunity, rather than pure speculation. It was a clear example of capital preferring targeted, earnings-backed AI stories over broad brush exposure. Taiwan Semiconductor itself became the fulcrum for the day's narrative. The stock surged after posting record profit and revenue and tying its stronger outlook directly to AI chip demand. That combination of a clean beat and a bigger, longer runway for advanced node spending effectively reset the mood around the AI hardware trade. For investors, TSM's print wasn't just about one company's quarter. It was confirmation that the supply chain at the heart of this AI cycle is still running hot. And that helped pull a whole ecosystem of related names higher.
Apple told the other side of today's story. The stock drifted lower, even as the major indexes ended in the green, a clear sign that money was rotating away from broad platform exposure and toward more direct AI infrastructure plays. In a tape that's rewarding proof of AI monetization, Apple's relative weakness became a clean barometer of how much investors are questioning the old shortcut of just owning megacaps for AI. For benchmarked managers, that kind of underperformance on an up day is a loud rotation signal. Eli Lilly highlighted how unsettled healthcare felt.
The stock slipped alongside a broader pullback in high expectation drug and obesity treatment names, where valuations are already rich. Layered on top of that, traders were weighing fresh health policy ideas, including direct consumer payments, and what they might mean for reimbursement and margins. The result was a cautious tape for the group. In a session driven by proof in AI hardware, Lilly's weakness underscored that policy-sensitive growth still carries a higher uncertainty discount. BlackRock delivered one of the cleaner upside stories in financials. The stock rallied after posting an earnings beat and announcing a meaningful dividend hike, signaling healthy fee growth and a willingness to return capital. That kind of print matters for a firm that sits at the center of global asset flows. On a day when financials were mixed, BlackRock's strength helped steady the group and reminded investors that beneath the rotations, the plumbing of the equity market is still attracting real money. ExxonMobil moved the other way, trading softer as crude prices pulled back. Hopes that tensions around Iran might be easing took some air out of the recent geopolitical premium in energy. In a session defined by AI chips and selective cyclicals, that left energy on the sidelines. Exxon's underperformance served as a reminder that today's rally wasn't about war risk hedging or commodity scarcity. The market's attention was firmly on growth, where earnings visibility looks clear. Goldman Sachs gave a useful read on risk appetite. The stock edged higher alongside firmer treasury yields and better action in some small caps, signaling that institutional investors haven't pulled back from taking risk. It wasn't a euphoric move, but in a day of selective participation, Goldman Trading Well hinted that trading and credit conditions remained supportive. For a financial sector that was otherwise mixed, GS helped confirm that today's tone was cautious risk on, not risk off. Into the next session, the market's checklist is pretty clear. First, does the AI hardware trade show follow through, or was today's chip surge a one-day relief move? Second, can leadership broaden beyond a tight group of semis and select cyclicals, or do we stay stuck in narrow mode? On top of that, the healthcare policy conversation isn't going away, and it's likely to keep that sector trading carefully. With a heavier macro data cluster still ahead, positioning feels flexible, but demanding. Investors want more proof, from AI earnings to policy clarity, before they're willing to chase this tape broadly. To wrap it up, Thursday didn't change the destination so much as the rules of the road. The market is still willing to pay for AI and selective growth, but only where the earnings math checks out. Hardware and infrastructure are setting the pace, while healthcare and defensives sit in the crosshairs of policy and risk management. From here, the next leg will depend on whether more sectors can join the party, and whether upcoming results keep validating, rather than challenging, the AI and soft landing narratives that are doing so much of the heavy lifting. Thank you for watching CatEye U.S. Stock. Stay curious, stay calm, and we'll see you next time.